Happy 2025 with a booming housing market. At least that's according to the National Association of Realtors and the Mortgage Bankers Association, who both recently put out their 2025 Outlook reports. And what I want to do in this video is go over what both of these organizations said, that we understand their opinions, and then in the coming days, I'm going to put together a full 2025 housing market video because, well, the National Association of Realtors and Mortgage Bankers Association might be a little bit biased, so you have to take what they say with a little grain of salt. And with that, let's jump right in. The National Association of Realtors says that existing home sales will jump up by 9% in 2025, and new home sales will jump up by 11% in 2025. And if that sounds good, just wait till you hear what the Mortgage Bankers Association said, because the Mortgage Bankers Association says that total mortgage origination is expected to jump up by 28% in 2025. Now, the interesting thing about this is not only do they believe that the housing market is going to grow, but they also believe that we're going to see some more economic concerns in 2025, not just in the economy, but also in the government. Here's what the Mortgage Bankers Association had to say in their report. Quote, "The job market will likely slow somewhat as we enter 2025 with fewer jobs added and the unemployment rate increasing to 4.7% by the end of 2025. Inflation will gradually decline towards the Fed 2% target by the end of 2025. Why is that interesting? Because the Mortgage Bankers Association believes that mortgage origination is going to jump up by almost 30% in just 1 year. But over that same year, they also believe unemployment is going to jump up to 4.7%. That means less people will have jobs, less people will have the ability to buy a house, but more people will be taking on mortgages. Along with that, there's also concerns about the government. Now, we know that 2025 is going to be an interesting year. I mean, there's a lot of different things happening. Trump is going to be entering the White House. He has a lot of new economic plans. We have concerns about the national debt. And we've been seeing a lot of shakeups in the stock market and just concerns about the economy. That's one of the reasons why on January 7th, 2025, I'm hosting a free live and virtual wealth building workshop where I'm going to be going over how you can, number one, systemize your wealth in 2025. Number two, how do you find unique investment opportunities in 2025? Because anytime you see change, that also means opportunity for financially savvy investors. So I'll go over how you can find those opportunities. And then number three, how do you actually research those opportunities? If you'd like to join me on this workshop, it's completely free, but you do have to register because we have a limited number of seats. It's on January 7th, and I'm going to be doing 2 workshops on that day, one in the morning at 10:30 a.m. Eastern Standard Time, and one in the evening at 8 p.m. Eastern Standard Time. So if you'd like to join, just make sure you reserve your spot because we have a limited number of seats, and I have the link for you down in the description below. Now, talking about some more concerns, here's what the National Association of Realtors said in regards to concerns about the economy. Quote, "Mortgage rates will not decline in tandem with the Federal Reserve Bank cutting interest rates." So remember, in 2024, we saw the Federal Reserve Bank cut interest rates multiple times. But despite the fact that the Federal Reserve Bank cut interest rates in 2024, the mortgage rates actually went up. I'll explain why in just a minute. But this is where the National Association of Realtors goes on to say, the reason why mortgage rates are not falling, even though the Fed is cutting interest rates, is because we have a, quote, large budget deficit. That means there's less mortgage money available. The government is borrowing so much of its money, and a large budget deficit will prevent mortgage rates from going down to 4%. In other words, the reason why you can't get a cheaper mortgage is because the government keeps spending so much money they don't have. And that might seem a little bit confusing, and I want to explain this, and I have explained this in previous videos, but I want to explain it one more time. The mortgage rate you pay is not set by the government, it's not set by the Federal Reserve Bank. It's set by your bank. But it is influenced by the central bank, the Federal Reserve Bank, and it's also influenced by the government. Why? The Federal Reserve Bank, which is the central bank of the United States, sets what's called the federal funds rate. The federal funds rate is the interest rate that your bank will pay when they borrow money from another bank. So you can think of it kind of like the wholesale price to borrow money. Your bank has to borrow that money and then they lend it out to you. So they're paying the federal funds rate. So as the federal funds rate falls, banks have more margin to lower how much interest they charge you. But then the interest that you ultimately pay is going to depend on the government. More specifically, it's going to depend on what the treasury rate is. Go to Google, search the 10-year treasury yield, and when you see that go up, your mortgage rate will go up. When you see that fall, your mortgage rate will fall. The 10-year treasury is the interest rate that you're going to get when you lend your money to the United States government for 10 years. Now, if you've been following the financial news in any capacity, or if you've been reading Market Briefs, which is my free financial newsletter, you know that the government spends more money than what they generate from taxes. In fact, in 2024, the government had the third largest deficit in the history of time. So the government spends a lot of money they don't have. And when they spend money they don't have, they have to borrow this money, just like everybody else. If you spend a lot of money at Gucci and you don't have the money, you got to put it on your credit card. Well, the government has been putting a lot of money on the credit card because we have more than $36 trillion of national debt. And this is where, for the last few months of 2024, more and more investors became more concerned about our national debt. I made a couple videos about this recently, but the Federal Reserve Bank kind of gave a warning about this national debt because the government's debt levels are growing a lot faster than the economy. And then more recently, our Treasury Secretary Janet Yellen wrote a letter to Congress urging them to act about this because they're concerned about potential national defaults if we don't come up with a plan for our national debt. All these concerns about our national debt and the government spending and the dollar have created concerns. That has caused the treasury yield to rise because when you are concerned about an investment, you want a better rate of return. Because the riskier the investment is, the higher the interest rate that you're going to want to invest your money. Like if you're going to invest your money in your broke cousin Bunty versus Amazon, you're going to probably expect a higher rate of return from your broke cousin Bunty because, well, that's a riskier investment. And so now, let's go back into your bank's shoes now. Your bank is going to weigh the different options. They can lend money to you, they can lend money to your broke cousin Bunty, or they can lend money to the United States government. And when they're comparing the options, they're going to say, okay, your broke cousin Bunty is a subprime borrower. He needs a much higher interest rate because that's a risky investment for us, the bank. The government is considered a, quote, risk-free return. So that's going to be the lowest interest rate. You're somewhere in the middle. But that government yield, the treasury yield, has been going up because of concerns about the government debt, the government budget, all these inflationary concerns. That means if the government is paying out higher returns, you're going to have to pay a higher mortgage rate as well. And this is why one of the reasons why the Mortgage Bankers Association has been talking about mortgage rates. And what they said is that the baseline forecast is for mortgage rates to end 2025 at 5.9%. And they're expecting mortgage rates, to stay at the level for the kind of near-term future after that. Why? Because of the government budget issues. They're saying that because the government debt levels are so high, because of the concerns about the budget, they don't expect mortgage rates to go back down to the 4% level very easily. The second part of that has to do with home prices. This is where the National Association of Realtors comes in, and they're expecting home prices to continue to rise despite all the concerns in the economy. The National Association of Realtors said that they expect home prices in 2025 to rise only 2% to around $410,700, and they expect median home prices in 2026 to rise to around $420,000. So the National Association of Realtors says that despite the concerns in the government, despite the concerns in the economy, home prices will keep rising and more people are going to be buying homes. The Mortgage Bankers Association says despite the concerns in the economy, despite the concerns with the national debt, a lot more people are going to be taking on mortgages, even if mortgage rates don't really fall that much. Now, the Mortgage Bankers Association does believe that mortgage rates will fall in 2025, but they do say that there's going to be uncertainty as to how much they actually fall and what happens during 2025, that we could see a lot of variance. The last part that I want to make about this is changes in the housing market, more specifically, that we are seeing a lot of people still buy houses with all cash. 31% of repeat buyers are buying houses with all cash, or are planning to buy the houses with cash for their next home purchase. So despite all the changes, people are still buying homes, even if mortgage rates are high. And that's changing the housing dynamics, the housing market. They also go on to say that the median age for a first-time home buyer in 2024 was 38, which is the highest we've ever seen, because home buyers are having to save for a longer period, or maybe wait until the quote bank of mom and dad give them money to actually have money for a down payment. So we're seeing changes in the housing market. The Mortgage Bankers Association and the National Association of Realtors are still very optimistic about 2025 and 2026. So what this means for you, again, take everything to say with a grain of salt, because nobody really knows what's going to happen. I want you to be a smart investor and a smart home buyer. I want you to buy a house when you can afford it. Don't buy a house you can't afford. And when you go out to buy the house, make sure that you can actually afford it. Afford the down payment, afford the monthly payment, and afford the move-in costs. Because the reality is, buying a house is not how you're going to build wealth. The way you build wealth is by actually investing your money. And the mistake that so many people make when they go to buy a house is they assume that because I'm paying this mortgage, I'm investing my money, that my mortgage is my investment. That is a lie. They also assume that because I'm building equity in my house, I have the savings account, which is my house, my equity that I can draw from. That is a lie. That's not how wealthy people think. Think of your house like a liability. I don't care if you buy a house or rent. I mean, it's nice to buy a house, but I'd rather you afford wherever you live. But think of your house like a liability. If you really want to build wealth, you have to invest your money outside of paying your mortgage. That means you pay your mortgage, you pay your property taxes, you pay insurance, and then after you pay all your housing costs, you pay for all of your bills, you still have money to invest. Where do you invest? Maybe stocks, maybe rental properties. Doesn't really matter where you invest, but you keep investing your money, because that's where the real wealth is built. Your wealth is not going to be built by just paying off your mortgage, because then the problem is, let's assume that good things happen. You buy a house for $500,000, it goes up in value. It becomes $1 million house. Great. You know what happens next? Your property taxes become more expensive. Your insurance is more expensive. And now, if you can't afford the higher property taxes, you got a problem. If you pass down this house to your kids and they can't afford the property taxes, you got a problem. And this is where, again, your house, great. You want to buy a house, you want to create memories, great. Don't spend all of your money trying to buy a house that you can afford. And understand the different things that are happening, but don't go and chase an investment, whether it's a house, whether it's a stock. Understand what's happening and buy what you can afford. And with that, Happy New Year, and I'll see you on YouTube tomorrow.